Hey, welcome again. So today we are talking about cash on cash rate. Again, all of the disclosures, I'm a real estate broker as well as a real estate investor. This is for information purposes only. So, cash on cash rate. If you haven't looked at my other videos, make sure you check out the 16 what we call CEs, contributing elements. I learned this early on from another investor friend of mine, and he kind of has these 16 contributing elements. Actually, it was 12, and then we added 4 more that kind of look deeper into the deal. So if you haven't checked that out, go ahead and check that out. But again, cash on cash rate. Pretty much the easiest way to understand it is the pre-tax cash flow that you have coming from a property divided by the initial equity. So for numbers purposes, let's say that you bought a deal that on an annual basis had $100,000 of pre-tax cash flow. Now this is obviously what would be considered your net operating income after expenses, etc. Let's say the initial equity for this case, let's say after all the closing costs, after everything, you brought the property for $1 million. So you invested $1 million into this property in order to get a pre-tax cash flow of $100,000. So that would be called 10%, or in this case 0.10 is your cash on cash rate. Now as we look into the contributing elements, there are multiple things here that sometimes a lot of investors are focused on, okay, what's my cash on cash rate? What is my return? You hear all of these numbers, but what we found is that there is so many more things to look into. So let's look. I always like to go through this example. When we look on a cash on cash rate, are we considering the location and the size of the property that we're buying? In this example where all you know is that you put $1 million in and you got $100,000 out for a 10% cash on cash rate, you don't know the location or the size. The income, sure, I guess we know that one. So that's one, we know the income. Appreciation, are you factoring in appreciation on this deal? So this is where a lot of our investors and some of our customers that we've worked with, what they'll do is what's called an average cash on cash rate. And that is a much more detailed investment analysis when they're looking at a property over a 5-year or a 10-year holding period, and then they account for appreciation and they're saying, okay, year 1 we got this, year 2 we got this, year 4 we got this, year 8 we got this. So the average cash on cash return that they are predicting is, for example, 15%. But that varies. In this scenario where all you're focused on is year 1 and the only information that you have is maybe your previous net operating income and then what you know you're going to buy the property for, and you're looking on this number, if you're only investing on that, are you looking for appreciation or maybe even depreciation if it's in a, in an area that is estimated to depreciate over time? So that you don't know. Expenses, sure, obviously if we have the net operating income, we know the net operating income is the gross income that we get from all of it minus all of our expenses, real estate taxes, management fees, etc. So we know the expenses. Price, obviously price is a factor. Maybe this person bought this deal for $1 million cash. Maybe they did some financing. So, maybe this is their 20% down, and this is the net operating income that they're getting after the debt that they pay, principal and interest. So price, yes, I guess we know that one. Leverage. Leverage is a huge one. Again, it's the financing. Are you considering finances on this one? What if this person, instead of taking this $100,000 cash and putting it on this one deal, what if all of a sudden he took $500,000, bought 2 deals that each one of them cash flowed, let's say $75,000, then his cash on cash return now becomes 15% because he's buying 2 deals. So are you leveraging your money to work for you in multiple ways in multiple different properties? So that's not considered. You're financing in your term, unless again in the scenario where you did take into account, if you're doing some financing, I guess we'll check that one on, that's considering Financing principal reduction. This one is huge. A lot of the exit strategies that we study will look at, for example, a cash out refinance on year 3 and then a sale on year 5 or on year 10. So on this one, you also have some principal reduction. On here, when all you're looking at is that he put $1 million in and they receive $100,000 out, what about the principal reduction? So the true cash on cash return, if there's any debt with this, is that this is being paid down. So the true cash on cash might be a little bit higher, because when you look at that, you know, that's reducing the principal that you're paying on it. So obviously you have the principal reduction, so that number might be higher. So again, we don't know this one. The tax benefits. Obviously taxes is a huge thing. Check with your attorney, check with your financial planner, check with your accountant, your CPA, whoever does your taxes, you know, make sure you know what's going on. On here, all we know is 2 numbers, net operating income and the amount of money that went in. What do we know is a rate. So we're not considering any tax benefits. The tax bracket, again, this is pre-tax cash flow. That means if that individual investor, or if you have a group of investors or a corporation that's buying it, and their tax bracket is, I don't know, let's say 22% for example, or 25%. This isn't considering any of that stuff. So at the end, yes, they might be getting 100,000, but if their tax bracket is 25, then all of a sudden this drops to 7.5%. So again, you're not considering the tax bracket. Rent increases. All you're doing with a cash on cash rate for 1 year, maybe you don't have a factor in there. So maybe I'll check that one off as halfway. Again, I like the averages approach, where if you looking at a deal and you analyze it for a 5-year hold period or a 10-year or 20 or whatever your hold period is ideally going to be, you can get an average cash on cash rate, and that obviously has more things factored into it. Other tax incentives. Obviously, you know, there's opportunity zones here, specifically in Miami. Also, there's other areas of the country that people take advantage of other tax incentives. For example, there's always things going on as far as energy tax exemptions, historic tax exemption, etc. These 2 things, they're not taking that into account. Reinvestment of cash flow. Again, this is where we get to kind of a more complex internal rate of return, but here, you know, in this scenario, we are assuming that this person is taking the distribution, so they are actually receiving $100,000 of cash flow back on their $1 million investment. So we don't know if instead of, you know, for tax reasons or for whatever other reasons, let's say instead of taking that $100,000 and let's say they did have a mortgage on their property, what if that year they took no distribution, if they took 0 and actually put that $100,000 towards a principal payment reduction? We don't know that. What if for tax purposes they had a good tax planner and they said, look, instead of you taking $100,000, leave $50,000 into the deal, take a $50,000 distribution, because if you take the full $100,000, that is going to put you at this income bracket and that's going to be worse. So there's multiple things to consider here. So again, you're not taking into consideration that reinvestment of cash flow. Closing costs. Again, in the scenario that I presented, I put that this $1 million is the full investment. Let's say it was a cash $1 million deal, included the purchase price, the due diligence, the closing costs, fees, etc., all that stuff in there. So that one I guess I'll check off. But again, typically when you're looking at a much more detailed analysis, if this was leveraged and they only put that amount of money in there, that might not be considered, you know. So this can go both ways. Capital gains tax. You know, this is always a huge number where we look at capital gains and how we defer capital gains as much as possible as real estate investors. So again, this is just looking as, you know, the money I put in, the money I get out. What's the long-term strategy? So that one, there's no way you're looking at that. Risk. Obviously, you know, for you to put in $1 million on this deal, you would have to have studied something about, you know, the location or the size. So I guess I'll check that one off. So you would have to study a little bit about what's going on, because obviously if you just threw $1 million into something expecting that you're gonna get $100,000, you're just betting on luck. So you gotta do your homework. So yes, definitely putting on some risk. So that's 1, 2, 3, 4, 5, 6, 7, 8. 8 out of 16. 8 out of 16. That means you did 50% of your homework. If the only thing that you got was, hey, your broker calls you up and says, hey, I got a great deal on you, for you. There's this property for $1 million. It's expected to get a 10% cash on cash return. What do you think? Should we move forward? If you say yes and you don't do any of this other diligence, or let's say you did, out of the numbers that we checked off here, you did these diligence, you've only considered 8 out of 16. Again, this is where we work tightly with investors, where we work tightly with attorneys, CPAs, tax planners, and other investment professionals, where they're looking at this stuff and they're not just taking a risk. You know, they're taking a risk, but they're taking a calculated risk. Again, you have to know what's going on in the market. That's huge. You know, for example, a lot of the things that you've seen our videos around Miami, we're showing you, hey, this is what's happening. Why is this happening? What's happening with the demographics? When you understand the possible appreciations that are happening, or that might happen, or that are being predicted to happen, you know, that's great. That puts you on the winning team. So hopefully this information helped you. Again, cash on cash return rate is just one of the things to consider. There are different investors. You might be comfortable at different levels, but just because you understand or you learn a cash on cash rate, don't just rely on that one thing. You always have to be looking into multiple things, multiple avenues. As you see, these are kind of the 16 elements that we consider when we look at and analyze a deal further. And again, if you spend, let's say, 2 to 4 hours of your time, or better off, your financial planner, or even your real estate broker, if they give you some of these numbers and you're able to analyze it, at least you have a more confident level where you're saying, okay, well, maybe I got 12 of these instead of 8. So then you're at a much more higher level of understanding of what this means. So if you invest into a deal, your exit strategies might contain a few other options than just relying at a cash on cash rate. So hopefully this can be useful for you. If you'd like me to cover any specific other topics, make sure you reach out. Have an awesome day.